We're looking at the forms that are important from the perspective of not getting a tax penalty and having the clients in compliance, but the forms that have the least amount of risk as to creating a taxable event if the clients misunderstand how to use the foreign structure. And so the form we're looking at right now is going to be Form 8865 for foreign partnerships. And we're starting off with the instructions. And as CPAs, we have a pretty high standard, especially when you talk to Cameco, which I really enjoy all their classes they have online. And you'll see that not every category has to file all the information. However, I would be very concerned if my client did not have enough information to file all of these forms. I want my client to know exactly what's happening with some foreign partnership, maybe more so than even with a domestic partnership, because suing in a foreign country is a lot harder than the United States and a lot more expensive. So it's really, I think, important for us as CPAs to have the clients to have some type of internal control by at least knowing what's going on. And so you can see they have a lot of information sheets. They even have a Schedule K1, which I think is nice. And the question would be, if your client is not the controlling partner, how many people are doing the K1, or who's doing the K1? So this is really important. Schedule O, transfer of properties to foreign partnership. By this time next year, this will be a very hot topic because this could be a taxable event by this time next year. So it's something just to put into your thinking cap. You want to watch out for that. Maybe come back to next year's seminar on this topic, because I will be spending more time on this next year. And once again, this will also be part of the same thing of the new IRS regulations. These are the regulations that are going to duplicate the concept under Form 926. The IRS had this authority back 20 years ago, back in 1996, and moving at the speed of government, which is not the fastest. So, but they're finally getting to it. And this has been a major tax planning arrangement for people that have partners in other countries where they had different concepts of taxation, different concepts of transparency, which is the term used now internationally for a pass-through entity like a partnership, or what we call disregarded. I want to go down to the categories here. Category 1, 50%. Or more than 50%. So looking at the controlled foreign corporation rules, and the IRS does this a lot. They take one form and they just duplicate it. We see this with the foreign trust form too. And it doesn't really give them what they need. So from our point as a tax CPA, it also gives us some planning opportunities, because the IRS is still thinking 1960 controlled foreign corporation rules. It doesn't mean that we want to not get all this information up here for our client, but it does give us some understanding where the IRS has their hot button. Category 2, greater than 10%. Category 3 is a person who places property under Section 721. This is the section that it makes it tax-free. This is the section the IRS is going to be zooming in on. So they've already kind of started the trend by putting this into the instructions. You're going to see that this category, excuse me, this category goes on for quite a bit of the instruction form. And so it kind of gives you an indication once again where the IRS is going. Category 4 is a person that had a reportable event, and these are some of the things they look at. Change of proportionate interest. Once again, a lot really like Category 2. It's a transfer of ownership in a partnership. Has it happened tax-free? profit sharing interest versus capital interest. Really a good example as to where the IRS has their hot buttons. Also a great example where tax planners have done the tax planning. So keeping this in mind, when you have a client during this next year, there's no regulations. You have really a open book on tax planning, just like people have had for the last 20 years. And you can still use some of these tax planning concepts. Disposition, same thing, looking at direct interest, once again, changing in the value, change of proportional interest. These are planning opportunities. If you have a client in a foreign partnership, which I have never had, they always seem to be in foreign corporations, but if you do, here's some planning opportunities. Once again, the planning opportunities are used more when you have a foreign partnership with people in other countries, quite often a family arrangement. I see this more often. And somebody's in a low tax country, somebody's in a high tax, somebody's in a nation that doesn't tax capital gains, so there's quite a few nations like that, and they allocate the income back and forth. So special rules for 1999, and all that is already in place for us. So with that overview, we're going to get to the actual form, which is right back here. We're not going to save this out. And as you may recognize some of this from the Form 5471, but this is really partnership tax law, and this is the non-recourse versus recourse debt. If you follow the IRS on this topic, it's been to the Supreme Court a lot of times. This is a special type of financing, usually for real property. You know that this is a place where the IRS has been beaten up, and they're still licking their wounds, and they still want to track this very carefully. To know if a debt's non-recourse, in my experience, I need an attorney to tell me that, because that is a special concept. It varies from state to state, from country to country. And so when you're dealing with a foreign debt, that's important. Information about other partners, pretty straightforward. Organization, activity, tax year, if the partnership must file this, so you want to know that. You know, I always like a foreign partnership or a foreign trust to file the domestic form, in this case a Form 1065. I really want this income to get into the IRS computer the way that I'm tax planning it. So if my clients can control anything, I get this form filed. Special allocations, a hot button. Just the answer yes means good chance of a tax audit. Disregarded entities, they want to know about that. Classified under the laws of the country. Once again, some countries may classify it as a corporation. So for example, Canada has a unlimited liability corporation, which means all the shareholders are liable for the debt. Under Canadian law, that is a corporation. It can do tax-free reorganizations under their law. Under our law, it's a general partnership. So that would be a good example here. All of this is more, as we know, more with the C corporation. Not too often that we'll see that with our kind of clients. Of course, you get to sign it here. Constructive ownership, you're going to use the rules under Section 707 for that, not Section 318. Affiliation schedule, income statement, only trade or business income and expenses. So once again, they're trying to break, because for international tax law, there's a big difference between trade and business income and investment income. Pretty straightforward. Partners distributed share. Once again, we've seen this from our Schedule K of the Form 1065. It looks just like it. I have no idea if this is inputted into the IRS computer system. That's what I like to do at Form 1065. Not required if you're a small partnership. Pretty much stuff that we've all seen as CPAs. Nothing that really takes a tremendous amount of international experience. Balance sheet for interest allocation. So a lot of investment income can be allocated on the ratio of assets. And we see this also in the corporate law. Wasn't discussed as we review the forms, but when you get into the tax planning, there's a special law that allows you to use this to determine how you want to allocate some investment income. Good tax planning opportunity if you want to use it, or you could use the actual direct a apportionment method. Reconciling the capital accounts, stuff that we've all seen in CPAs, transactions between controlled foreign partnership and other partners and related entities, much like with the controlled foreign corporation. Same type of questions really, once again, lets you know the IRS's hot spots. It also lets you know where the tax planning opportunities are. So nothing that is really new. Amount borrowed, maximum loan balance during the year, maximum loan balance during the year. We saw that versus the average balance. And that's really the form. So it's pretty nice. And like I said, the transaction between partners and partnerships will be the main item. Next year, there should be a form in addition to this form for you to file. And just like I said, you want to watch out for the date that that regulation comes out. You don't want to be blindsided, because generally the new tax law is effective the date the regs are first released as proposed regs or temporary regs. So with that, we're going to open up for questions and answers and then go on to disregarded entities.